Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful. And world on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you gotta get spotted. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun.
Welcome. Oh man, my screen is all messed up. Hey guys, no camera here for this FOMC, the FOMC of our lives. Oh my gosh. I am so, like, I'm not even in any trades and I feel so effing nervous. This is just gonna be a really wild ride. So you guys were still coming down on 75 basis points. So here's what we're gonna do. We'll wait. We'll wait until after the event hits and then we'll do another poll. Say you want to buy or sell ES. I'm hearing a lot of stuff from the news squawk in my ear here. News squawk. This posts a tweet of Katniss Everdeen doing her little kiss thing, you know, before she goes into battle, right? Oh man. I'm actually surprised that the 10 years are putting up 500s here before 10 minutes before. Maybe they'll pull 5 minutes before, but man, I wouldn't. Who wants to get filled on a lot 10 minutes before the biggest FOMC of ever? Not of ever, of our lives. You're watching 4 live streams. Well, I will be pushing the press conference audio through here, so I already got that set up down here. I guess since the press conference doesn't start until the bottom of the hour, I can move that down so that we can get, and then I'll put my market tape over here in the treasuries so we can see if there are any big orders. Yeah, how's that? That's good. This is going to be interesting how Twitter goes, because like, here's the thing is, like, not only am I not sure, like, is it going to be a 50 or a 75 basis point hike? I guess it's probably going to be a 75 basis point hike, but whatever. Let's say it's a 75 basis point hike. I'm not 100% sure if that's a buy or a sell on ES. You know what I mean? Like, let's see, did I miss anything here in the Discord? Nope. It's of our lives, not for our lives. You still get to keep your life. It's okay. You don't have to worry about that. It means probably never going to be a bigger FOMC meeting. Like, up until now, it was always like, this is the biggest FOMC meeting we've ever had, right? But now this is the one that we're ever going to have. Possibly could be the biggest one we are ever going to have. Yeah, you know what? Something crazy happens, and then we'll do this again next FOMC, and they'll be like, are they going to do 75 basis points or 2? 2%, you know? Okay, cool. Got some stuff to play later. It sounds like it's going okay. Oh, till tomorrow. Okay, whatever. That's okay. I'm so scared. I know, right? This comes out and there's going to be like 1%, and they're going to be like, no, and everything just crashes. No. I was going to be 75 probably, right? Probably. I'm going to be on the record. I'm just going to go with the consensus. I think that we have a higher than priced in probability that Nick Timmeros is wrong. Listen, he better get a good question in when they're calling, right? If it's not 75, he better, be one of the first people to get to ask a question, and he better get grilled or something, like, right? Fed president should be like, well, you don't have any inside information. You shouldn't have said that, right? I don't know, man. I don't know. It's all a little crazy. The treasuries are buying up into this. They have pulled a little bit. Okay, they're 200s now. So now 5 minutes ahead. They're doing their thing. It's just it's so. I want to say like fluid. Like it can just go anywhere it wants now at the moment. It hardly takes any lots at all. You see that? You may have a large enough account to make it move a tick, possibly. So let's see here. So the consensus expectation is 1.5, right? Because it's 0.75 right now. Yeah. Okay. All right. 2 minutes. Yeah, remember how rebalance flow helped equities rally and we may have the same this month, but much bigger. Says JP Morgan, we estimate close to 50 billion equity buying due to MBIM, GPIF, SNB, I don't know what any of those acronyms mean, and an upper bound of 198 billion by US defined benefit plans. So overall, this is well above historical norms. Yes, probably. I wonder how far the ticks are going. Dude, this is gonna go like, yeah. I think that if this doesn't go a whole point in the treasuries, I would be a little surprised. But sometimes you get this thing where it's like everybody's all pumped up for the number, and then it comes in line, and they kind of pause there for a second. They're like, so what do we do now? Right? Okay, so we should just note that there is going to be dot plots too, right? So not only is it just going to be like whether it's 50 or 75, there's going to be a lot of data and information to try and parse here when it comes out. I'm not going to be putting risk on here with it. Got about 30 seconds left. All right, here we go. Keep your arms and legs inside the vehicle at all times. Oosh, it's down. 75, it's 75. 75. Okay, so the median dots, I'm hearing 3.4. Oh, officials projected rates rising to at least 3% this year. Cool. So does anybody trade this over here in the micros? So we had a huge move down. We had a huge move up. We are now right back where we started in the treasuries. S&P 500 doing similar, and they are just all over the place in ES. Oh my gosh. This is just... You think the S&P... I don't know. It's as expected. So no crazy like 1% or any of these things that some people were saying they should do, right? 75. I think that with the 75 that what Powell ends up saying at the meeting here will be important, right? Yeah, I'm gonna move this over here. Okay, here's the statement. Open an image, new tab. Here's the statement. So what did they add in here? Committee is strongly committed to returning inflation to its 2% objective. Voting against this action was Esser L. George, who preferred at this meeting to raise the target range for the federal funds rate by 0.5 percentage points. Patrick Harker voted as an alternative member at this meeting. Okay, so there was one person that still said that it should be 0.5, not 0.75. Okay. So the Fed whisperer Nick Timiraos comes through. I shouldn't have doubted him at all. But now here we come into, is this a buy or a sell? So I'm going to say 3780. 3780 is going to be our center point. Yes, 3780. Do you buy or sell? $37.80. Do you buy or sell? Kind of. I mean, it looks like at the moment that we're going. Well, okay. I said 37.80. We're already down 10 points. Yeah. So the statement, there was two interesting things in there, but there was not that much of a change in the statement, as they have been apt to do in the recent past. Fed vote in favor of the policy was 10-1. Oh, I didn't know that there was that many on the. Oh, I guess I should have known that. Okay. Yeah, they're pushing. They're selling all the things except for the dollar. The dollar is taking off, and the Japanese yen is probably the only one here on the board that has like a super clear direction, and they are just getting pummeled in the yen. Oh boy. Gold and silver hammered as well. Copper hammered. This like pretty much everything is selling here. See, some of like the small caps and corn have like pretty good gains on the day. Let's see if they give them up. Like RTY is going down, is getting hammered pretty hard. Okay, so now that they've decided to push the bottom end of this, now it's really going. The micros are not really trading, so it's kind of hard to see where we're at, but it looks to me that they're heading to 4% here, or sorry, 3.5%, not 4%, 3.5. 3.5 seems like their destination to me. I don't know. We'll see. Fed balance sheet reduction will proceed at the announced pace. Okie dokie. So, Yeah, this makes the press conference interesting, don't you think? Don't you think? By the way, severe flattening on this move. 5-year, just look at the difference there. The lows on the 5-year versus the 10-year. Yeah, what are those 4 super illiquid DOMs on the bottom? Seems rather useless. Who in their right mind would trade that? Yeah. I don't know. Look, you actually get a 5-tick spread there in the micro 10-year yield futures. I you know, if I was you know, a gambler, might be worth trying to hit into that 8 lot there at 3.46. Yeah, why not? Why not, Kevin? Come, we could make it work. Not as big of a move as you thought. Well, they're just getting started. Here in the S&P 500, the question will be, does this push us below 3,700? Because again, there's probably going to be some options, you know, magic going on below that price that might make it difficult for us to break. Like at the moment, this doesn't look like that's going to be enough, right? Like it'd be a 700 point drop. Probably not. Sorry, not a 700, but a 100 point drop. Yeah, it's not. Maybe after the press conference, we'll see. Well, what did I say? 3.46? Nope, you would have lost $10. No, I trade those. That's where I put my orders in. Can't you just put more interesting? No, that's that I use those. Listen, y'all think it's cool. I know what I know what you're saying here, Kevin. Everybody's saying it. I'm not with you guys on this one. You're all like, oh, the micro 10 years. They're not that interesting. Nobody's gonna do them. This product has failed. No, I disagree. The 10 for real. I love it. I absolutely love it. I love the construction of the instrument. I love that, you know, I can trade a spread trade without having to worry about the difference between, you know, what is a 10-year and a 30. It's the on the run futures, all of that stuff. It's very nice. It sucks that we aren't seeing anybody trade the 5-year. Okay. But the 10-year is doing okay. And I think that there's a lot of value in trading it if you're an informed trader, and that over time it will become more popular. I think so. And yes, I put my orders in the micro 10. Or you know what, man? I'm still kicking myself about it yesterday, because we took a trade yesterday and I made like $20, and I was like, okay, well, this move is over. We're done. Ended the session for the day, went and did my morning meeting, came back, and they had already moved another like 7 basis points. I was like, what? So it could have been $100 trade there in the micros, and I left it on the table. Did it just, you know, well, I didn't leave it on the table, but yeah, I wasn't gonna sit and babysit it all day. Okay, fine. Nick Timmeros, these charts show how 18 FOMC officials who participated in today's meeting expect economic growth to slow quite a bit next year, with the jobless rate rising slightly. Huh. Yeah, I guess you convinced me with the 10-year, but you can't convince me with the other 3. No, yeah, no, totally. Listen, I've tried doing it in the 5-year and gotten like royally screwed over on it before. Or did you go back and find that one? You're not there. I took a trade in the 5-year ahead of a really big news event. I forget what it was, and I was wrong. And there was no way for me to get out in the 5-year because there was like literally no liquidity for it. and it wouldn't even let me market order out of it. No joke. And so I hedged my position by taking an opposite trade in the 10-year and then worked out with my broker what we had to do. And so what we had to do was we had to start putting bids in and like slowly move it up to make the spread small enough that it would actually let me put an order in there. And then I was able to put a limit order out up here and get filled and exit my position. And then the 10-year kept going, and I think it actually made $10 on the day. So it worked out, but that was probably the dumbest thing I ever did. Like on a normal day, I think that as a swing trade, that trading the 5-year for a spread trade can totally work out. I also think that there is an opportunity out there for somebody that has the appropriate data to be able to do market making with spreads between the 5 and the 10. But to try and trade the 5 outright during a large news event like this, no, absolute account suicide, right? I hated micro oil when it had. Does the micro oil really have 3 to 4 tick spread? Yeah. When I trade, usually when I'm trading the 10-year, there's maybe 1 tick spread, and I'm able to time it to catch the edge to where that doesn't really matter too much. So I've been pretty good at getting a few ticks. Key takeaways. Firm commitments signal the Fed prioritizes crushing inflation and is ready to assume the consequences. The dollar is set to continue its gradual advance, building on monetary policy divergence, and confidence in the Fed may lower long-term yields. In other words, bear flattener, right? He's Jerome. Yes, in 15 minutes, and we'll have. And I'll stream the audio through here. Like beginning. Oh yeah. Well, there is micro gold too, right? Yeah. And now copper. I haven't tried looking at the copper one, but I'm super interested in copper. Like if I come across some good data sources to help me be up on the up in copper trading, I'm totally down. I'll be all into it, man. Because that's it. You know, a hard commodity that's not quite so zany as oil. That sounds like something we could trade. The Fed is signaling that they plan to be around 100 basis points above neutral for the next 2 years. That is a pretty serious message. Fed officials projected a policy path on Wednesday that would take interest rates to around 3.75% next year, says Nick Timmeros. Well, believe it or not, we're only at 3.43 on the 10-year. Forex Live's comments, you'd like to see a bit more dispersion, maybe some creative thinking. Instead, the best and brightest just rubber stamped the market pricing. Yeah. Well, I don't think that you want to come in and say something that like really surprises them. Do you? Like, no. There are these guys. There's it's so like here, I'll show you the dot plot. Okay. So by the end of 2022, they're saying 3.5. Well, look, by the end of 2023, they're saying 4. So when you look at the 10-year, and the 10-year is not to 3.5 yet. That's a little interesting, isn't it? And a little bit more dispersion in 2024. But longer term, they think that it will just come back to the neutral rate. Okay. But yeah, they are kind of saying that like they're going to have to keep, because neutral rate is supposed to be 2%, right? So I guess we're going to be above the neutral rate for 2 years. Okay. Bitcoin to break below 20K before the end of the year? Oh, that's a good question. So they moving? Well, they're moving down, but not quite. It's not quite clear what that we're not seeing huge momentum in Bitcoin, at least not compared to other things, although we are getting some volume in Ethereum here. So it could happen. And if it does happen in this situation, that could get ugly over there, right? I don't know. I don't own any Bitcoin, so I don't have to worry about it. Love it. Fed swaps price 75 basis point hike for July. And 140 basis points over July, September. The dollar took a pretty good jump up there, but look, they're coming all the way back. You see it's catching some bids now? Yeah, the movement in Bitcoin is relatively constrained. Honestly, the movement in the 10-year is somewhat constrained. But we did get almost the full point that we thought we might. We were about 30 seconds away from it. So the top was 115.12, and the bottom was 114.20. So we would have needed to drop another 16 ticks, right? Get down to here. So I mean, relatively speaking, close, but not quite there. But hey, there's still plenty of time left, right? This press conference could be interesting. Mohammed A. El Rain. The Fed has significantly moved higher its interest rate path while also front-loading it a lot. Oh, elegant language there, Mohammed. Unusually, it simultaneously revised down its growth projections in a notable manner, consistent with a stagflationary baseline, a fatter recession left tail, and a thinner right tail. What does this mean to mortgages? It means I hope you already own your home. Or that you refinanced during the heat of the pandemic, because the mortgage rates are only going to continue higher. As crypto markets collapse, Kraken, the U.S.'s second largest exchange, is being divided by an internal cultural war driven by CEO Jesse Powell. In recent months, he has debated if people can choose their race or who can say the N-word. Employees are stunned. What? That's what Bitfinex. You know that there's an FOMC thing going on right now, right? We're talking about Kraken. Now I'm reading out your tweets. You're making me look like a fool too. The Tether fraud exchange Kraken, which allowed Bitfinex shareholders to wash trade Tether so they could artificially maintain the peg, turns out to be an actual scumbag. Who could have predicted this? Yeah, I bet. Are they saying that he's a right-wing provocateur? That's kind of what that sounds like. They're making it seem like. Overall economic activity appears... Wait, was that in the statement? Where was... Oh, gosh, dang it. I don't recall seeing that. Let me come back here. Oh, you're right. They did put that. They changed the statement used to say overall economic activity edged down in the first quarter. Household spending and business fixed investment remained strong. And they changed that to say economic activity appears to have picked up after edging down in the first quarter. Yeah, that one is kind of a little I don't know. It's has things picked up since the first quarter? Kind of feels like it got worse. Am I wrong? Well, I'm not going to argue with Daddy Powell, okay? I'm not going to argue with him. I should maybe recenter my DOMs here. Wow, almost half of respondents in a new poll see the likelihood that the U.S. will cease to be a democracy in the future. People listen. It never pays to be pessimistic. Not in the long run, at least. It only pays to be pessimistic in the short term. Pessimism only makes good trades, not good investments. Well, after seeing a little bit of downside movement off of the announcement, gold is actually edging a little bit higher and is still above 1800. Actually above 1825. The real loser here, though, I think is the Japanese yen, yeah? Well, and Ethereum. Ethereum is down 10% today. Yeah, let's go by net. Let's sort by net change here. What are the worst ones today? Ethereum, Bitcoin, oil. Oil down 2% today. And then followed by the treasuries, copper, soybeans, and the euro. Okay, so the euro is only down 0.19%. 0.19%. Can you imagine sitting at Jim Cramer's? I absolutely can. You know what bothers me about Jim Cramer is I think it would be so cool to meet Jim Cramer, and I don't think that I would have anything to bond with him over other than being bald. I guess we could commiserate being bald together. But other than that, because, it's like he's always like, okay, where are you from, caller? And then he talks about that local college sports team or whatever. I don't watch that. I followed basketball for a while, but I just can't get myself to care anymore because it's like, it's too much time and I don't get it on television. I don't really have television anymore. It would be wild. Do you think? No. Most of what you see on TV is just an act, right? He gets it. He gets it. What moves markets? Orders. What moves orders? Well, a lot of it is hype. And he knows that if you come out and you get all hype, that people watch. It has to be on something. I'm sure that he's done stuff in his past, but I would like to think that he's a reformed man. But I don't know. I don't think he's ever said anything about it. I'm sure that like at the height of his hedge fund days, he was doing crack and then, it got too much and he changed his ways. And that's when he decided to become a TV news anchor. Is that? I don't know. I say I don't know a lot, don't I? Because you know what? Like, what's going on in the market right now? Does anybody know? Seriously. This is some zany stuff that's been happening this week. Some former Coinbase employees found out that they had lost their job on Twitter, and others when they couldn't log back onto their work laptops. Oh, that would be the worst. He should have been in Wolf of Wall Street instead of Leonardo DiCaprio. You've seen the guy. You know what was interesting is Martin Shkreli. So I went from Wolf of Wall Street to Martin Shkreli because like honestly, Wolf of Wall Street was last generation Sexter. Now it's Martin. Martin's our generation's guy that went to jail for his market shenanigans and is now respected and listened to by people everywhere for who knows why, because we're stupid, I guess. But you know what? Martin Shkreli has good stuff to say. It's just that almost everything that he says is stuff that like I feel like I already, at least from what I've heard from him, I feel like I already know. He's like, hey, you can make money going short. I'm like, no duh. Okay, we know what kind of hedge fund he would run if he was in charge. He would do the long short strategy, which, by the way, hasn't performed very well in the past year. Priced at 3.5% with a good chance to be set at 3.75% by the end of the year, says Left Hash on Twitter. I think so. I'm kind of sitting here like I can't believe that the 10-year is anywhere remotely close to 3.4. You're going to watch Martin Shkreli. Must have been funny lingo. No, he was... I have to say that he is like... Martin Shkreli is not like the Wolf of... What's the Wolf of Wall Street's name again? I can't remember off the top of my head. But like their disposition and their presence are not the same at all. Like Martin is kind of a timid Weasley kind of feeling guy, you know? Like I don't mean to say Weasley like as an insult necessarily per se, but like he's the kind of guy that is a little soft spoken and it kind of makes you a little suspicious of him. You know what I mean? Right? Like that he must be a shrewd and smart guy. Right, that's Martin Shkreli. Whereas the Wolf of Wall Street is like, where did this guy? Yeah, Jordan Belfort. Jordan Belfort is like, where did this hype man come from? Good grief! And like he still does it on TikTok. He has a TikTok account, if you can believe it. I don't think he posts content that much. Forex Live tweets not much in the way of market moves, but the stock of Nick Timiraos and Steve Leishman is up. Yeah, you better bet. Man, Nick Timiraos is the man of the moment for sure. You think that they're going to call on him in the press conference? How am I not following Steve? You know, there's this whole thing where like they say that Twitter unsubscribes you from things. I think that's happening to me. Like, why am I... Steve, did you piss Twitter off? I'm not following him. Let's make sure he's on lists too. Traders, yeah, good, safe. Love Steve. Steve's always been one of my favorites. When Steve Leishman and Rick Santelli have an argument, that is just the best thing. I love that stuff. They both understand like here's a place where it's like you have two guys, they both understand the interest rate markets really well, and they have very, very different approaches to them. So when they argue, it's a treat. I love it. CNBC is talking smack now, you say? And the funny thing is that I usually I prefer Rick Santelli. Like I really think that Rick Santelli is, I identify with him more politically, but when I'm listening to the argument, I usually side with Steve. Yeah. Steve's a good guy. Why? How could CNBC be talking smack? Listen, Nick was the one. It's the Wall Street Journal is the one that should be talking smack right now, right? They have no clue what controls inflation. Well, no, Nothing. Listen. So here's the first thing: is that you don't control inflation per se. Oh, here he is. Here we go. Hold on.
Inflation is causing.
Powell is getting.
We're strongly
going
committed
now
to
with
bringing
a statement
inflation
of
back
press,
down, and we're
press say
moving
we're moving
expeditiously to do so.
expeditiously.
So hold on. Let me turn off
We
News
have both the
Squawk.
tools we need and the resolve that it will take to restore price stability on behalf of American families.
They have resolve. That's a sell right there.
The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down.
One lot micro ES. Why not?
Strong labor market conditions.
Like in regards to my larger portfolio, it would be a really smart idea to just go take a contract short here. Yeah, but I don't want to. That account is super small at the moment, so I don't want to do anything crazy.
Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments.
See Nick right there in the middle?
Activity edged down in the first quarter.
He is front and center.
Swings in inventories and net exports more than offset.
Is that on purpose? Did they tell you where to sit? What is it about Nick
that real GDP growth
that
picked up this quarter,
gives him the scoop? I want to know.
remaining strong.
Why Nick?
In contrast,
Why am I not Nick? I'm jealous now. Why am I not? Nick seems like a cool cat.
and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth.
Also, Powell, you got to work on the tie. Always a little ski wampus. Just don't.
FOMC
Just
participants have marked down
stop using the easy method to tie your single Windsor.
GDP
Okay?
growth running below.
Like I know that it's easier, but it doesn't look as good.
The labor
Take the long route, do it right, or do the double.
unemployment rate near a 50
You know, you're a serious man. You can do a double Windsor.
historical highs and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024,
Oh, really?
levels that are noticeably above the March projections. Inflation remains
Excellent. I thank you.
longer
Listen,
below 2% over the 12 months ending April.
it comes with experience.
6.3%, excluding the volatile food and energy categories. Core prices rose.
I like the color and everything. Like it looks like a nice tie. You just gotta
change
you,
in the
you
consumer
can do
price
a better.
index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger.
You know, it's probably a good thing that I'm not like a journalist that's there at the meeting, because I would bring my laptop. I would make sure to have like
crude oil and other
a super clicky keyboard,
rushes in
typing away like mad. And the,
boosting prices for gasoline and food, and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer run value. The median projection rises
S&P is just awfully volatile here, ain't it?
and declines to 3.4% in 2024, still above the median longer run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%.
Somebody on Twitter here is saying a dovish dissent from Esther George is just wild, and PIQ on Twitter response, I guess she didn't read Nick's Wall Street Journal piece.
75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can.
Did I miss something? It sure seems like
our overarching focus is
the market is reacting to something that he said there, but I'm not sure which statement it was.
Expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in a...
maybe it was him saying it does not expect 75 basis point moves to be common.
The upside over the past year, and further surprises could be in store.
That must be what they're reacting to.
Incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy.
That's what the market was. Well, yeah. Well, I think it's one of those things where like one big trader thinks that that's a big deal, and then everybody else picks up on it, right?
We at the Fed will do everything we can.
I've seen people on Twitter starting to tweet it now too. I do not expect moves of this magnitude to be common.
And I look forward to your questions.
That sent them higher, though, man.
With Reuters, two related questions.
Look, S&P 500 moving up now. Hey, listen, I have the poll still open, so you can change your vote if you want.
In June and July. And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions. subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function.
You look at the liquidity out there. There's no way I would trade this.
We think it's helpful to provide even more clarity than usual. Again, subject to uncertainty in the outlook.
Like now we're below
I
3.4.
think over the course of this year,
Perfect short opportunities coming.
markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if
Yeah.
the economy
See, here he's saying if you're surprised by this move, then you're not listening to what I'm really saying.
even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did.
They did it.
And that's really how we made the decision.
Hey, Gina?
Oh, he wanted a follow-up question, and they didn't give it to him.
Gina Smilek with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have? And why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for.
Okay.
At this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data.
You need a bigger
inflation
monitor.
risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the
Saw
upside.
this thing for a monitor. Hold on. Let me see if I can find it.
Expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so.
Look at this monitor.
Federal funds rate, even after this move, is at 1.6%. So again, the committee is moving rates up
The age
expeditiously to more normal levels.
LG dual op
came to the
28-inch nano IPS.
We'd like to do a little more
2560 by
So I think that the
2880.
SEP gives you the levels that people think are appropriate at a given.
So it's like this monitor, the monitors that I have,
There.
but like double
As I
stacked.
mentioned, 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us
Pretty-
in the July meeting.
Pretty
In
hefty
that
monitor arm too.
more normal range, and that's a desirable place to be because you begin to have more optionality there,
Hey, you see the monitors? Look at that.
which you would proceed going forward. Just talking about the SEP for a second. What it
Would that be big enough for you?
Committee participants widely would like to see policy at a modestly restrictive level at the end of this year, and that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to.
So I don't know. Go search that. Maybe that's the monitor for you.
So, and if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening and in a range of maybe 3.5% to 4%. And that's generally what people see as the appropriate path for getting inflation under control and starting back down and then.
Okay, so basically what he said is that the way that we decide what percentage rate is correct is by what seems right and what the market seems to be pricing in, which is a little concerning.
Steve, thank you for taking my question, Mr.
Steve, let's hear Steve.
You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year. Do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive and how much of that is a normal positive rate that ought to be embedded or not?
Wasn't the news negative?
Thank you.
Well, it was until he said that we don't expect this to be normal.
How high does the rate really need to go? And this is, the estimates on the committee are in.
No, I'm not going to take one.
3.5% to 4%. And how do you?
I'll make money in my big portfolio.
The longer run neutral rate, you can compare it to that, and we think that's.
I have long exposure to equities. I don't need more.
At broader financial conditions, so you can look at asset prices.
I'm kind of sitting over here stocking with where I might want to try and take rates long for the possibility of 3.75 at some
You can
point.
also look at the yield curve and ask all along the yield curve where is the policy rate. So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate, that affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand. And that can happen both from supply and demand, right?
Oh, did you see how careful he was about how he said that?
Then available
Because he knows that there's all these activists online saying that the Federal Reserve wants to put us out of jobs.
With our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I think I would think about it.
But this 3.8%, 4% get it done, because it gets the job done and breaking the back of inflation.
He doesn't know. I hope so.
It's certainly in the range of plausible numbers. I think we'll know.
What?
Honestly, though, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're going to find that out empirically. We're not going to be completely model driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
I don't know how I feel about what he's saying. I'm an empirical guy. I would prefer him to say, well, we have an empirical model that suggests what the correct rate is, and our models are in line with our policy. But it sounds like he's saying that's not the case, that they're just spitballing it and seeing how the market reacts.
All of your colleagues had set those expectations.
You have to do a push-up, yeah.
And I know you just said
Here's Nick.
What changed was really the inflation data, the inflation expectations data. But I'm wondering on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at it,
You can ask the real questions.
expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that index of common inflation expectations at the board has moved up after being pretty flat for a
So
while.
there you go. Inflation expectations from the Michigan Sentiment Survey is something that was one of the things that pushed them over.
Deciding to move ahead with 75 basis points. Today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
You know, I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate. 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
We don't know how restrictive. Thanks. That's confidence inspiring.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to
Say
go
a mortgage is $2K a month. What will it be now?
make policy guidance a less effective.
I'd have to go and calculate that. I'd have to.
Kind of symmetrical
I'd have to do a little. I probably should know off the top of my head, but I'm not 100% sure what I'd have to use.
To take your second question first, yes. I mean, I think
Let me hold on.
we're resolved.
I can find this.
But we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance. And so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened.
Okay, so
significantly through the
it's
expectations.
probably about $200 more.
I think that's been a very healthy
Probably about $200 more a
to
month,
be happening. So
if not more than
I
that.
would hope that our
So on Google right now,
any guidance that we give is always going to be subject to things working out about as we expect. And
on
it's
Google right now, it's quoting me
we're looking for
6.827.
something specific, and that is progress on inflation. We want to see progress. We
Yeah,
want to see
it's not like the end of the world,
down
but
until it flattens out, and that's what we're looking to see. And if we don't see that,
that's just me going, okay, if the interest rate rises 1%.
a longer period, that could cause us to react. But we will soon enough. We will be seeing some progress at some point, and we'll react.
We'll see progress at some point. Yeah, okay.
Our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, pretty close, very close to our meeting. Very unusual to one that would
Thank you.
actually change the outcome. So I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, one or two times. So I don't think it's something that'll come up a great deal.
Colby.
Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory,
Looks like ES giving up those
that
gains.
meets that criteria, and how is the committee thinking about the potential trade-off of much higher unemployment than even what's
Where are you guys on our poll?
if inflation is not moderating, at the
So 62% of you, after 21 votes, I'm going to end the poll.
what's the potential
Say
trade-off of
sell.
higher higher unemployment, even what's forecasted in the SEP, if inflation is not moderating at
Close it when we're like basically right at 37.80, so it's fair,
What
okay?
we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down.
A series, so that means 3, right?
But and right now,
Reset the counter.
rate is well below neutral, right? So soon enough, we'll have our policy rate. Let's assume the world works about like the SEP says the policy.
Here's what's going to happen is we had a rate that was like this, and then we had one that was like this, and there was one that was like this.
You'll be making
So now it's going to do the double head fake thing, and it's going to go down even lower, this next one, and then we're going to say, is that a series of declining? Well, but it's only 2 there.
Ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done.
Yes, it's really reacting to that.
We saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about,
Yes, they are
about
wacky.
declaring victory. But again, the implementation of our policy is going to be flexible and
You
sensitive.
can make or lose a lot of money off spreads in
concerned
these
now that,
situations.
to bring down inflation, it's going to require more than just some pain at this point?
So again,
Oh my God, did you see his face on that one? He was like, oh, what a terrible question.
they're objective, and this is what's reflected in the SEP.
I want a screenshot of that. When was
To
that?
bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't, the monetary policy stance doesn't affect those things. So
Okay, watch this.
having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down
at this acceptable pace.
and you have
A lot
the
of
second part of
surplus
demand. Take, for example, in the labor market. So you have 2
I
job
think I rewound it a little bit too much.
person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, and where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it.
Just some pain at this point?
So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle,
Boy, can you see that?
when demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than
Can I get a better?
relationships
No.
that you see in the
Maybe.
textbooks
Okay, wait.
would suggest.
We'll go
because of the
frame by frame now.
situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
I think that's the screenshot. I'm gonna play it. Oh,
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate
think that,
necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you.
So You're right. In the SEP, we have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts. And I would characterize that if you were to get inflation down to on its way down to 2%, and the unemployment rate went up to 4.1%. That's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6%, because we saw it, frankly, we saw it last year in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs?
I'm having a hard time getting the exact timestamp.
Again, we don't seek to put people out of work. Of course, we never think too many people are working.
There we go.
People need to have jobs.
Thank you.
But
see, he's watching the TikToks.
You really cannot have.
He's watching the TikToks. He knows people are saying this bullshit.
Without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had
Hold
before
on.
the pandemic was, that's what we want.
This is just too funny.
You see disparities between various groups at historic lows. We'd love to get back to that place, but to get there, it's not going to happen with the levels of inflation we have. So we have to restore that.
Thank you.
And
I agree.
It really is in service.
That's right. When you're right, you're right.
Of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Boesler with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate in the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement. Also,
Which is like, ooh, that's a tough question.
Induce a recession now to bring inflation down.
Not trying to induce.
Yeah, sorry. Here's the live screen now. I got my 2 screenshots.
2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. That the SEP has.
Look at how peeved he is, man.
To a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war.
You need a more powerful computer, man. I'm joking on it here.
Prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger and longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. The sentence isn't, it kind of says on its face that monetary policy alone can do this. And that just didn't seem appropriate. So
totally using this on my TikTok.
Given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own?
They hiked 75 basis points.
Get worked out. Thanks.
Well, yeah, I think you've seen. Again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think. The situation really since the consequences of the Ukraine war become more and more clear. What you're seeing is the situation getting more difficult.
I accidentally caught the screenshot of the yellow on it.
Lots of countries are looking at inflation of 10%, and it's largely due to commodities prices. But all over the world, you're seeing these effects, and so and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So that is really, and by the way, headline inflation is important for expectations. The public's expectations.
I'm not the only one that finds that face funny, right?
And headline inflation. Core inflation is something we think about because
I'm not the only one.
Future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So
looks like a great gift to me.
Are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be in coming months.
It's like, yeah, it looks like somebody just pissed in his Cheerios.
You talk about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're, of course, watching very, very carefully for that. And, looking at the retail sale, the big store numbers.
And then this one is like, oh, I actually have to answer the question, don't I?
Summary of what we see is you see continuing shifts in consumption. You see some things sales going down. But overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people.
Yeah, I'm probably right. He's probably right.
That's what we're seeing. We're not seeing a broad slowdown.
You can't see my picture.
But it's still at quite robust levels.
I'm still live.
We see the economy slowing a bit, but still.
I don't have the camera turned on.
Healthy growth levels.
So then as you are raising rates in
charging.
this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending. But we watch everything. We watch business fixed investment, which actually has softened a bit. We watch.
No, this is live. I'm caught up.
Everything, but consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is
funny Bitcoin,
in a strong position,
very volatile and resolving to the upside with everything else for the moment.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words,
that's a good question.
Oil prices, if they keep going up, if that's going to be the component that drives expectations, would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So
that's a good question.
We're responsible for inflation in the law. And inflation means headline inflation. So that's our ultimate.
Ooh, he just said that.
To look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools. So we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect, really. I mean, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also other things. So we can't really have much of an effect. But we have to be mindful of the potential effect on inflation expectations from headlines. So
ding, 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 ding.
And we can't do much about the difference between the elements that make up headline that are not in core.
Could I just, as a follow-up, get a clarification on the SEP when the
I still got work to do today, but I just take a little bit extra long lunch is all.
Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand.
Yeah, one of the things that's been keeping me working where I have so long, I mean, I like my current manager. He's good, and it's hard to find a good manager.
Everyone's SEP,
but they're really flexible.
This rate increase and what's going forward.
Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since
Nick tweeting about what he just said there. I think that what he just said there about core versus headline inflation is really important. Even though the Fed has traditionally paid a lot of attention to core inflation, this isn't a good idea right now. Headline inflation is what people have to live with. In other words, if you are worried about inflation expectations, you have to focus on headline.
or that it might send confusing signals given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings in real time. So, and that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure.
I'll explain it afterwards, Kyle.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're
oh man, that was the most
of the dangers. But I will say the worst mistake we could make would be to fail, which it's not an option. We have to restore price stability. We really do, because everything, it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So
Nick expounds here a little bit. Would the Fed focus more on core inflation because its tools can't really address the other components of headline inflation? Powell, who was trained as a lawyer, answers, we are responsible for inflation in the law.
The public generally sees us as very likely to be successful.
Well, let me turn him down for just a second, because this is really important. Okay, core inflation is basically inflation minus food and energy prices. Okay, that's core. The headline inflation includes food and energy prices. And since it's oil that is the primary driver of inflation right now, the difference between core and headline inflation is really important. And what Powell is saying there is that you could have a situation where core inflation calms down, but headline inflation is still high because oil prices remain high because of government policies. Then they would need to keep interest rates high. Basically, this whole thing that we've been talking about all week, where because Biden can't fix the oil problem, we might just have a cap on our growth here and keep the interest rates high, Powell is basically confirming that's how it works.
It's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation.
Yeah, good luck trying to get. That's the whole point, is he can't control oil prices. So there is a situation where they just have to keep the interest rates high, even though they can't, even though it's not really going to make the headline inflation number move down.
The question really,
and you will just have to keep growth low in order to prevent inflation expectations from becoming unanchored because of oil.
Have confidence that we have the tools and we'll use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
What can Biden? There's a number of things that Biden can do. He had a.
Thank you, Chris Rugaber at Associated Press. You have talked about.
Well, that's a little bit too long of a thing, but I made a TikTok about that yesterday.
But aside from rises in commodity prices, such as
I think it's
we're also seeing.
I don't think that it's something that a professional should be surprised about, but it's just a really good reminder.
I mean, how persistent do you see those underlying measures of inflation, and how do you expect to? Where do you see those going in the near future?
Yeah. So, as I mentioned, I think in my opening statement, the inflation has started. It started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. Some of that will be passed through of energy prices, but it's you're experiencing services inflation. Shelter inflation is high. So the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy. Hi, Chair Powell. Nancy Marshall again.
You think it has to fall here? I don't think it has to do anything.
Landing is possible, and how would you define that at this point, considering the revised projections?
Oh boy.
Employment, GDP, inflation.
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. That would be, I would call that as meeting that test. Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is. And I do think it's possible. Like I said, though, I think that events of the last few months have raised the degree of difficulty, created great challenges, and again, the answer to the question, can we still do it? There's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back down to 2%, which we think is essential for the benefit of the public, and also to put us on a path back to a sustainably strong labor market like the one we had before the pandemic.
Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that
economists are worried, huh?
More risk of a recession than a 50-50 path of rates. So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So, as I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And we're going to get here by the end of the summer somewhere in the 2s probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, then we're going to adapt. And I would say this is highly uncertain environment, extraordinarily uncertain environment. So again, we'll be determined and resolved, but flexible.
Hey, Evan.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given
Did you guys screw up?
extraordinary volatility in financial markets, are you concerned that QT will make that worse?
That was a really bizarre question.
What was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. It's hard to overstate the extent of interest we have in that question, morning and night.
You bet.
But you have to understand the context.
Thank you.
Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China, the war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces are, what extent are they going to be sustained? In other words, will we go back to a world that looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack. Although I think we have of course a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing.
Well, the treasuries are extended higher, and they have now moved a full point.
We've communicated really clearly to the market.
The low at 114.20 and the high 115.20.
Be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think, markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Last question will go to Mark.
Who was that guy?
With Bankrate. Wonder what your
I want to know who that was.
About the outlook for the housing market, given the years-long increase in home prices and
go back and find him
sharp
again.
rise in mortgage rates, and all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support.
Evan Reiser, Market News International.
The true unemployment rate was well higher than that. So, and that that was rates are low, and now they're coming back up to more normal or above levels. So, in the meantime,
there he is on.
While demand was really high, obviously demand for housing
Twitter
changed from wanting to live in urban areas to some extent.
Okay, so he's marketnews.com.
In single-family homes in the suburbs.
Or that's who he's with.
And so the demand was just suddenly much higher. And
stupid spam again.
Prices moving up very, very strongly for the last couple of years.
Glad you didn't take a trade off of you.
Rates have moved up. We're well aware.
Pretty lucky. You gambling fool, man.
You're seeing a changing housing market.
Lucky one, though. You made money today from what it sounds like.
How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's, obviously we're watching that quite carefully. You would think over time, so there's a tremendous amount of supply in the housing market of unfinished homes. And as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So
I'll follow this guy.
Even in a world where rates are up. So it's a complicated situation. We watch it very carefully. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place, and housing availability and credit availability are at appropriate levels. So thank you very much.
Okay, that was it. I just that question by Evan Reiser was a little, I don't know, the way that he put it was kind of a little, was like you thought he had a gotcha or something. Was a little, but I think that I might just be picking up on some strange social cue. I don't know if it was necessarily meant to be that way. It was a little weird to me. Okay, so just to make sure that we all understand this, because he's not saying something that I think is different from what the market already understands, but it is something that certainly if you're new, you might not understand, and that you would want to keep an eye on, right? And that is that there are two different inflation numbers that we typically look at. Well, actually, let me try and go even bigger than that. There's 5 main measures of inflation that we tend to look at, okay? There is the headline and core consumer price inflation, and there is headline and core producer price inflation, and then there is PCE prices, okay? So the consumer price inflation, basically what they do is they call a bunch of people up and they say, how much are you spending on these kinds of goods and on these kinds of goods? And you're supposed to keep track over, a couple weeks, how much you're paying for those particular things. And then that gets reported back. And that's basically how they figure out that number. Okay. So there is when the number is released, there is a headline and there's a core number. The core number is basically the same number except for the energy and food components taken out. So you go into the report, there's all these different categories. The core number has the energy and food categories taken out of it. And why do they do that? Because the core PCE is more indicative of the future, right? In other words, oil is really volatile, so we kind of have to discount oil a little bit, essentially, right? We don't want to analyze the headline number as much because it includes that oil, and that's going to give all of our models and everything bad signals, right? But what he's noting there is that their mandate is to tackle headline inflation. So if we're getting inflation from oil, yes, it may not be indicative of where the future is going to be going, but that's still what people feel. You still experience the inflation. And so the Federal Reserve's mandate is still that they have to deal with that inflation, even if it's just from oil. And even if it could end quickly, right? And so we're facing an issue at the current time where it is looking like oil is a major factor in inflation right now, and it's contributing significantly to inflation everywhere else. But we're also looking at a situation where at least many of us, myself included, are not so sure that the problems with oil are going to go away anytime soon. It kind of looks to me like this is going to be an on-again, off-again problem for quite some time, because the administration has policies that are just not very good for people pumping more gas. Essentially, you're not going to invest in oil with the way that the administration is treating the industry right now. You're just not. And then we can't build any more oil refineries. So we're basically, our oil refinery capacity is just, that's it, right? So there could be a situation where the Federal Reserve has to keep interest rates high for a considerable period of time merely because of oil. And that would be very bad for the economy. That's one of the scenarios that we're facing right now. So that's why it matters, right? You think you're wrong about oil? Well, it's not really dumping right now. I mean, come on. You come over here and you look at oil on the chart, right? Like, does that look like oil is dumping to you? I mean, it's still within the uptrend channel, at least. Could possibly break, but even then, I would have to go out to here, right? Okay, does that look to you like oil is dumping? No. And like the thing is like maybe there's a cap on this. Maybe they can't get above 130 here, but I think that it'll be hard to get back below 100, right? So we could be in this high level for a while. It could be a problem for a while. ZN is? No, today's moves are all kind of a little weird. So let's come back through and look. All right. 10-year treasuries up substantially, but some flattening. I don't think that graph has completely worked itself out, but when you come and you look at one of these ones like this, you can kind of see there was some initial flattening and then some steepening, and it's not quite all worked out, but we'll have to see. This could end up being like a peacockishness moment. It is possible. It is possible. Who knows? S&P 500 reversing and coming up to basically, well, they're above yesterday's high at least. We'll say that. They're not to like highs of the week. We'd have to go all the way to 38, 37. And remember that there's kind of a cap at 3,900. So that might be a price level tomorrow that we might have difficulty getting above. Then next week they'll probably be more free to move, and we can see where they can go. We already looked at oil there, so I mean, I guess oil did have a down day, 2% down today, but the longer run thing here is higher, right? So we would have to see a lot more downturn to really fix the inflation problem being driven by oil, right? There's a long way to go. Powell said if we dump oil, the market will pump and he will lower rates. I am not short. I don't have any day trades on at the moment. I do have equity exposure through, my 401k and my IRA and my Mad Money portfolio, essentially. So I do kind of want stocks to go up in general, but yeah, I can handle some pain. Made some mistakes over in there. There's a couple of stocks that took a little bit more pain than they needed to, but it's okay. Copper's the one that I'm really interested in, right? Because copper's been on a downtrend the past 2 weeks, and has kind of been signaling some concerns about global growth. But if, it does look like that for the moment that we're getting short-term turnaround, right? So if this is able to continue and we're able to see copper participate in that rally and we get a week or two of up movement in copper, then that could be really good for everything else, right? All right. Well, you got about 30 minutes on the S&P 500. I don't know where they're going to end, but my voice is already kind of feeling a little tired, and I've got some other things from the day job that I would like to look into. And I think that I gave you guys everything that I can give you that you need to know. So tomorrow's going to be an interesting day. Next week is going to be an interesting week, probably. So I'll see you guys then tomorrow morning, bright and early, 8:30 Eastern time. In the meantime, stay profitable, or please, but don't blow it all. Save some risk for later. There's no reason to. I know it's volatile and it's moving around and it seems like, oh, I got to make money on this, but probably the best opportunities for us are going to be in the future. All right. Isn't that always the case? The best opportunities are in the future, guys. All right. See you then.